Warren's Money Buffet provides insights into financial strategies and market trends. It emphasizes the importance of informed decision-making in investments. Warren's Money Buffet provides insights for educational purposes, not as financial advice. Investing carries risks, including potential capital loss. Always consult a qualified professional for personalized advice. This platform is independent of Warren Buffett and Berkshire Hathaway. The author holds no positions in discussed securities or assets. On this channel, we explore personal finance strategies. We'll delve into portfolio critiques, retirement accounts, and the role of leveraged exchange-traded funds in aggressive investment strategies. Real case studies like a young investor's Roth individual retirement account will illustrate key principles, offering actionable advice to enhance portfolio performance and financial literacy. Explore Warren's Money Buffet, a unique approach to personal finance. We feed you investment topics like portfolio critiques, retirement accounts, and leveraged exchange-traded funds. Learn through real case studies, such as a young investor's Roth individual retirement account, and gain actionable advice to enhance portfolio performance and financial literacy. Today, we're tackling a hot debate from Reddit. Should you sell your rental property and invest the proceeds in stocks? A financial planner claims this move could net an extra $1 million over 25 years. But as always, the devil is in the details. Let's break down the math and see if the hype holds up, and we will also look at some of the advice given on Reddit. Please remember, this video is for educational purposes and is not financial advice. Here's where the investor stands in regards to the home. The homeowner bought the house for $900,000. Today it's worth $1.5 million. They have a great low 2.7% mortgage and make $2,500 a month cash flow on the property. Because they lived there, they qualify for a $500,000 capital gains exemption. Their planner says sell and invest in stocks. But does that really make sense? Let's crunch the numbers. If they sell after the mortgage and costs, they walk away with about $1 million, tax-free. Invest that in the S&P 500 at a 10% average return, and in 25 years it could become nearly $11 million. That's the magic of compounding. The planner's math is solid, but is it the whole story? On the other hand, keeping the property means $2,500 a month in profit, plus rent increases and appreciation. Over 25 years, that could add up to $6.4 million. It's less than the stock scenario, but there are other factors, like the value of diversification and the headaches of being a landlord. Being a landlord isn't passive. You deal with repairs, vacancies, and tough tenants. But that 2.7% mortgage is an incredible deal, especially with inflation higher than your interest rate. Sometimes, the value of a great loan outweighs even big investment returns. Reddit brought the heat on this one. Crimson Raider absolutely nailed it. If the financial planner charges a percentage of assets under management, of course they want you to sell and give them the money. That's a massive conflict of interest. And one poster makes a great point about depreciation recapture. That's a tax bomb many people forget about. You can't just look at capital gains. There are other taxes lurking. And of course, someone suggested dividend stocks. Because apparently every financial discussion needs someone recommending dividend stocks regardless of the situation. Listen, if you don't need the income now, chasing dividends in a taxable account is just volunteering to pay more taxes. You want total return, not immediate income that Uncle Sam takes a bite of every quarter. This dividend obsession needs to stop. Here's my take. There's no universal right answer. If you hate being a landlord, hate the stress, need the money, sell it. Take that $1 million and sleep better at night. But if you like real estate, believe in the location, and want diversification, that 2.7% mortgage is irreplaceable. Here's a thought nobody mentioned. Do a cash-out refinance. Pull out $500K, invest that into stocks, keep the property. Could be the best of both worlds? Maybe, but definitely more complex. But here's my biggest issue with the financial planner. claiming they'll make an extra $1 million over 25 years like it's guaranteed. Nobody, and I mean nobody, can predict market returns 25 years out. What if we get another lost decade? What if real estate in their area explodes? What if tax laws change? This certainty about long-term predictions is the biggest red flag. Past performance doesn't guarantee future results. That's investing 101. So what's the answer? Both strategies can work. Real estate has made millionaires. So has the stock market. The key is understanding your situation, your risk tolerance, and your goals. But always, always, question advisors who directly profit from your decision. That's not advice, that's sales. What would you do? Sell the property or keep it? Drop your thoughts in the comments. And remember, the best investment is the one you understand and can stick with. Next up, we're reviewing a 24-year-old's $17,000 Roth IRA. The big question: should they keep their 3x leveraged ETF? This is a classic case of high risk, high reward. Let's see if it makes sense for a young investor. Reddit portfolio. Roasts offer community-driven critiques of investment portfolios, analyzing stock picks and asset allocations. They highlight mistakes, risky bets, and unusual strategies, encouraging learning through humor and peer feedback. These roasts reveal common biases like chasing hype, helping investors identify pitfalls and improve diversification, reflecting social media's influence on retail investing behavior. This case study features a young investor with a $17,000 Roth IRA spread across index funds, sector ETFs, and tech stocks. Their strategy is long-term growth with dollar-cost averaging and dividend reinvestment. By balancing high growth and stable assets, they're aiming to maximize returns while managing risk. Here's the actual Reddit post and a snapshot of the portfolio. The investor lists 6 positions, but the account shows 10. This is a common issue. Many young investors over-diversify, thinking more is better, when it often just adds complexity and overlap. Our Redditor has 10 ETFs in a $17,000 account. That's like wearing 10 watches, unnecessary and confusing. VO is a great pick, but UPRO, a 3x leveraged ETF, is a red flag. VUG, VYM, and VTI are all solid, but there's a lot of overlap. This portfolio needs some streamlining. Before we roast too hard, let's give credit where it's due. At 24, having $17,000 invested and using a Roth IRA is impressive. They're up 25%, plan to max out contributions, and have an emergency fund. The foundation is strong, but there's room for improvement. UPRO is a 3x leveraged ETF, meaning it triples both gains and losses daily. While it sounds exciting, the risk is massive. Volatility decay means you can lose money even if the market is flat, and in a downturn, losses can be catastrophic. These products are for short-term traders, not long-term investors. A 3x leveraged exchange-traded fund seeks to achieve 3 times the daily return of its underlying index through financial derivatives and debt. It resets daily to maintain this leverage, leading to potential compounding effects. Primarily suited for short-term trading, these exchange-traded funds are not ideal for long-term holding due to volatility risks. 3x leveraged exchange-traded funds offer potential for high returns in strong markets, benefiting active traders through amplified gains. They provide tactical boosts and diversification. However, they carry increased risk of large losses in downturns, require active monitoring, and can erode value over time. Not suitable for risk-averse or long-term investors due to complexity and volatility. Let's look at an example of why holding a leveraged ETF long-term can be bad. Look at this UPRO chart. In 2022, when the S&P dropped 18%, UPRO fell over 63%. In a real crash, it could lose nearly all its value. While UPRO's price today is only slightly above its 2022 peak, VO has recovered by over $100 per share. This shows how leveraged ETFs can lag far behind over time. VO, by contrast, had a much smaller drawdown and has gained significantly since its 2022 peak. This demonstrates the contagion effect. Leveraged ETFs amplify losses and often fail to recover as quickly as traditional index funds. Next issue. There's also a lot of overlap in this portfolio. VOO and VTI are nearly identical, and VUG's top holdings are the same as VOO and VTI. This means you're paying extra fees for the same exposure, which isn't efficient. VYM, a dividend ETF, doesn't make sense for a 24-year-old's Roth IRA. With decades to grow, you want maximum growth, not income. Chasing dividends now means missing out on much bigger long-term gains. My recommendation: simplify to 80% VTI and 20% VXUS. This gives you broad U.S. and international exposure with minimal fees. Ditch the leveraged ETFs. They're for traders, not retirement savers. Now what? About that $20,000 emergency fund, unless you have major responsibilities, that's probably too much. Keep 3 to 6 months of expenses and invest the rest in a taxable account. Stick to the same simple allocation and dollar cost average over time. Quick shout out to the comments. Someone suggested adding XRP for utility. The only utility crypto provides in a retirement account is teaching you expensive lessons about volatility. Bottom line, this investor is already ahead of the game. With a few tweaks, simplify, avoid risky bets, and stay the course, they'll set themselves up for long-term success. If you want your portfolio roasted, drop it in the comments. And remember, boring portfolios build wealth. But massive respect to user BK Weeth, who dropped an entire investing education in the comments. This person clearly knows their stuff, talking about asset allocation, risk tolerance, and the beauty of index funds. If you're watching, you're doing the Lord Bogle's work. Remember, folks, the best portfolio isn't the most exciting one. It's the one you can stick with for 40 years without panic selling. Next, let's dive into one of the biggest stories of 2025. The US dollar's dramatic slide and how it's reshaped global investing. This year, the dollar has dropped about 8.5% against other major currencies, its worst start in over 30 years. What's driving this? Investors are nervous about tariffs, a ballooning federal deficit, and even the long-term stability of the U.S. financial system. Central banks around the world are hedging their bets, shifting reserves into gold and other currencies. The result? The dollar is under pressure, and it's having ripple effects across every asset class, from stocks to gold to real estate. Here's what we'll cover in this section: why the dollar is weak in 2025, how this affects your international investments, the historical context for dollar moves, the pros and cons of currency hedging, and finally, whether you should hedge your bets or embrace the currency roller coaster. First, a quick overview. The dollar's weakness isn't just a headline. It's a fundamental shift driven by economic uncertainty, trade policy, and global diversification away from U.S. assets. For investors, this has created both risk and opportunity, especially if you hold assets outside the U.S. Let's look at the numbers. Year to date, the U.S. dollar is down 8.5% against major currencies. That's not just a blip. It's a major move. Meanwhile, the Morningstar Global Markets ex-US Index is up 14%, while the U.S. stock market is basically flat. For investors, this means your international stocks are suddenly looking a lot better when you translate those gains back into weaker dollars. What does this mean in real life? If you held European or Latin American stocks this year, you're smiling. The weaker dollar amplified your returns. For example, European equities have staged a huge comeback, with the financial sector leading the charge. Latin American markets and even real estate investment trusts have also outperformed. Why? Because when the dollar drops, your foreign investments are worth more in dollar terms. It's like getting a free bonus just for having global exposure. To put this in context, let's rewind. The dollar was strong during the 2010s, peaking during the pandemic and geopolitical crises. Investors flocked to the dollar as a safe haven. But history shows these cycles don't last forever. After long periods of strength, the dollar often enters multi-year downtrends, like in the 1970s, late 1980s, and early 2000s. Each time, unhedged international investors enjoyed a tailwind as foreign currencies strengthened. Currency hedging reduces volatility, smoothing returns by protecting against adverse currency movements. Over the past decade, the iShares currency-hedged MSCI EF exchange-traded fund outperformed its unhedged counterpart with 8.9% annualized returns. However, hedged exchange-traded funds have higher expense ratios and can reduce returns during dollar weakness, with indirect costs and tax inefficiencies. The United States dollar's weakness, driven by high inflation and economic challenges, has historically benefited unhedged international investors. Post-1985 Plaza Accord, the dollar's depreciation improved returns for unhedged equity investors. From 2002 to 2008, a prolonged dollar decline provided a currency tailwind, enhancing returns for unhedged international funds. Unhedged exchange-traded funds like iShares MSCI EAF exhibit higher volatility at 12.3% compared to 9.7% for hedged exchange-traded funds. This increased volatility can lead to higher risk-adjusted returns, as indicated by a Sharpe ratio of 0.85 for hedged exchange-traded funds. Investors must weigh the potential for greater returns against the increased risk of currency fluctuations. Here's the big takeaway. Currency exposure isn't just a risk, it's a diversification tool. Unhedged international funds have a lower correlation with U.S. stocks, meaning they zig when the U.S. market zags. That can help smooth out your portfolio's ups and downs and give you more opportunities for growth, especially during periods of dollar weakness. Let's talk costs. Hedged ETFs often charge 2 to 4 times as much as unhedged ones. They also have hidden costs from rolling forward contracts and can trigger more taxable events. Over time, these extra costs can eat into your returns, especially if the dollar stays weak and you miss out on those currency gains. So, what's the right move for you? If you can't stomach currency swings and want steady returns, hedged ETFs might make sense. But if you're in it for the long haul and want true diversification, unhedged exposure could be the way to go. Remember, the best portfolio is the one that fits your goals and lets you sleep at night. And with the dollar's wild ride in 2025, global diversification has never looked smarter. To wrap it up, 2025 has been a wake-up call for investors who ignored currency risk. The dollar's weakness has rewarded those who diversified globally and embraced unhedged international assets. As always, don't chase last year's winners. Focus on building a resilient, diversified portfolio that can weather whatever comes next. If you enjoyed this breakdown, hit that like button, subscribe to our channel, and drop your questions in the comments. Until next time, keep your money working as hard as you do.